example, in this example, we're going to look at a specific capital budgeting decision about replacing an old asset with a new asset. So as we talked about in the Chapter 1 lecture, there are three types of cash flows to consider. One is the initial investment amount. How much is the new asset going to cost? And two, what are the operating cash flows generated over the course of the timeline of the project? And third, what is the terminal cash flow when the project is over? What can we sell the assets for? So the main point of doing this is to show that what we're focusing on here are the incremental cash flows of having the new asset over the old asset. And in doing so, we're taking into account the various opportunity costs, like we talked about in Chapter 1. So in this example, we're going to look at, refer to one of my favorite TV shows, Arrested Development. And in the show, they have a frozen banana stand. And the main character, Michael Bluth, in this example was considering, a revitalization project of the banana stand to make improvements, basically to buy new assets and replace old assets. So, there's a few things that Michael is going to be considering. One is, what is the cost going to be of the new asset, and how much can he get for the old assets, and also, what is the marginal improvement going to be in having the new asset over the old asset. And then lastly, when the project is over, after 5 years, what are the terminal cash flows going to be? What can he sell the assets for? So, as for the initial investment, Michael figures that it's going to cost about $50,000 to completely redo the banana stand. But at the same time, he figures he can get about $10,000 for the old equipment that he plans to replace. And, what makes it tricky here is that when he sells the old equipment, he may owe taxes or he may save taxes. But we have to consider the net proceeds taking into account taxes. And so it's a little bit complicated. But to do that, we have to figure out what the book value of the assets are. And so to do that, we have to refer to the MACRS recovery period schedule, which tells you how much to depreciate each year. And so to figure out the book value, it's just the cumulative depreciation amount over time. So in this case, he originally purchased the assets 3 years ago, so these are the old assets, purchased them for $40,000. And so the question is, that purchase, what is the book value on the firm's balance sheet today? And that's going to be $40,000 minus cumulative depreciation, which is going to be totaling 71%. So, if you look at the first 3 years on the schedule, it's 20%, 32%, and 19%. We add those together to get the cumulative amount, subtract that from the $40,000, and we get $11,600. So $11,600 represents the book value, which is the purchase price minus the accumulated depreciation. Okay, so he sells the old assets for $10,000, which is actually less than the book value amount of $11,600, and so he recognizes a tax loss on that transaction. And at a 40% tax rate, that means he's saving $640. Now, at the same time, we also have to think about how the inventory and the net working capital may change with the new assets. And he figures that he has to increase current assets by $5,000 and current liabilities by $3,000. So just as a reminder, this is what the MACRS recovery schedule looks like. And it tells you, depending on the type of asset and the recovery period, whether it's 3, 5, 7, or 10 years, how much to depreciate each year. So for the initial investment amount, we have to follow this formula. The first is thinking about what is the new asset going to cost. Michael expects $50,000. Second, what are the after-tax proceeds from the sale of the old asset? Well, he gets $10,000 for it, and he saves $640 in taxes. And third, what is the change in net working capital? We have to increase that by 2,000 net, right? So this is what the numbers look like. The cost of the project is 50,000. Proceeds from the sale is 10,000. We actually save 640 in taxes, and we have to increase net working capital by 2,000. So all in all, that means a total net initial investment amount of 41,360. So the next question is, how are the operating cash flows going to change? And we're thinking about the marginal benefit here, so of having the new asset versus the old asset. So we're going to start simple, which is just thinking about revenues, sales, and basic expenses. And then we have to consider depreciation and taxes, which gets a little bit more complicated, but it's really not so bad. So if we consider the banana stand as it is now, what we call the old assets, it generates 150,000 in sales and 100,000 in expenses, so netting 50,000 a year. But if we replace the old assets with new assets, then the banana stand can generate 175,000 a year with expenses of 115, netting 60,000 per year. Okay, but we have to take into account taxes. In order to do that, we have to take out depreciation. So we have to calculate the depreciation amounts for each year. And all that entails is taking the purchase price of the asset, multiplying it by the amount of depreciation according to the MACRS schedule. So if we look at the depreciation amounts for the new banana stand over the coming 5 years, then that's going to be, for each year, 50,000, which is the investment and cost of the asset, multiplied by the depreciation per year. And so we get the numbers right here. We do the same thing for the old asset, which, as you recall, cost 40,000, but 3 years ago. So we're already 3 years into the depreciation schedule. And so, mapping it over the next 5 years is going to be 40,000 by each of these amounts for the remaining 3 years, and then 0 for the others. And so this is the formula, if you remember from the lecture in class. It's kind of complicated, but all it is sales minus basic expenses minus depreciation, which allows us to get the taxable income. We compute taxes, take them out. We add back depreciation because we don't want to take into account non-cash items for the operating cash flows, and then we get the operating cash flow. So for the first year, the new banana stand, for example, it would generate 175,000 in sales, 115,000 expenses, minus 10,000 in the depreciation for the first year. If you recall, here it is right here. That gives us 50,000. EBIT allows us to compute taxes, which is going to be 40% of that, so 20,000. And so ultimately the free cash flow is going to be sales minus expenses. We would subtract out depreciation and then taxes and then add back depreciation, but obviously those cancel out. And we get 40,000. We do this for every year using the depreciation expense amount, and we get the time series for the cash flows over time over the next 5 years for the new banana stand versus the old banana stand. So what we're doing here is sales minus expenses minus taxes. Taxes here takes into account depreciation, right? So this is another way of doing it, or another way of presenting it. In my mind, it's a little bit simpler, but you get each of the steps with this one. So sales minus expenses minus taxes equals 40,000 for the first year, and the amounts after that. Now, what we're concerned about is the marginal cash flows, right? So the incremental cash flows of having the new asset versus the old asset. So we just take we take the new asset cash flow minus the old asset cash flow. So then we have the time series of cash flows of the incremental cash flows. And third, lastly, we're going to take into account the terminal cash flows at the end of the 5 years. When the project is over, Michael will reevaluate the banana stand or whatever, but we're going to sell the assets. Now, if we had kept the old assets, they would net $2,000. But if we were to purchase the new assets, it would net $10,000. And this is at the end of the 5 years, right? What they can sell the assets for. And we're just going to assume for simplicity that there will be no change in the net working capital, which would also affect it. But yeah, so the objective here is to compare the net proceeds for selling the old asset versus the new asset. Right? What difference is there? And that's what we're trying to figure out. What makes this complicated is that we have to take into account taxes, right? In order to compute the tax amount, we have to know what the book value is. And for that, we need to know the cumulative depreciation amount. So, if we go back here, you can see that, for the 5-year recovery period it expands into 6 years because it assumes that you buy in the middle of the first year, right? So, but the last year amount is 5%. So, for the new asset, what's going to be left for the book value that hasn't been depreciated yet is only 5% of the original $50,000 purchase price. So it's $2,500 that is still on the balance sheet of the firm, right? And so this $2,500 represents the book value. So to compute taxes, we have to figure out, well, is the sales price of the old asset or of the new asset at the end of the 5 years, is it above or below the $2,500? And since we're saying that they can sell them at $10,000, that's a $7,500 gain, taxable gain, that is taxed at a 40% rate, which would make a tax bill of $3,000. So the net cash flow of the sale of the $10,000 is actually only $7,000 because there's $3,000 that is due in taxes. Okay, so what taxes are owed on the sale of the old asset? Well, the old asset has been fully depreciated. So on the balance sheet, the value is 0, right? So if they're able to be sold for anything, that would be counted as a taxable gain. So we are saying that they can sell them for $2,000. So 2,000 times 40%. Tax rate is $800. So the net proceeds of the sale of the old asset, while we sell them for $2,000, we will also owe $800 in taxes, meaning the net amount that we actually get would be $1,200. So the terminal cash flow here, the relevant cash flow, is going to be the difference between the two. 7,000 minus 1,200 equals 5,800. So now we have 3 sets of cash flows, right? We have the initial investment amount, we have the operating cash flows, and we have the terminal cash flow. Now we can look at them all together jointly to decide whether or not this, revitalization project of the banana stand is really worth it. Right? And so essentially what we're doing here is a NPV analysis where we input all of these cash flows into the calculator. We have to also input a cost of capital, and in this case we're going to assume 6%. And it's going to tell us what the net present value of the project is. And if that NPV is greater than 0, then that means that Michael should accept the project because it's creating value. But if the NPV is less than 0, that means that it's negative NPV and the project is not worth it, right? It's value destroying rather than value creating. And so, if you put the numbers into the calculator, which I can show you here, so this is what the calculator looks like. You have to switch to cash flow mode. And first of all, the initial investment amount is going to be $41,360. So $41,360. It's the investment amount, so it has to be negative. We enter that in. Go down to the next cash flow. $8,080. Enter that in. It occurs once. Go down. Second cash flow is $10,480. Enter. That occurs once. $9,000. Enter. Occurs once. 8,400. Occurs once. And lastly, as the last year is the summation of the operating cash flow plus the proceeds of the sale of the new equipment. And so that's 14,200. Input that in. And lastly, the cost of capital is 6%. 6%. Compute net present value. Gives us a positive amount of $411. So the NPV is positive, greater than 0, and its value is $411. So that suggests that, according to these numbers, Michael should go ahead with the revitalization project. And that is the capital budgeting replacement decision.